We are talking about Intuit, ticker symbol INTU. And reading through this analysis, the fear driving that massive sell-off has a very specific name. They're calling it the SaaS-pocalypse.
The SaaS-pocalypse, it's basically the growing realization across institutional finance that generative AI isn't just going to make software as a service companies more efficient.
Right. It's not just a helpful tool.
Exactly. The fear is that it's going to obliterate their core business models entirely.
Wow. So this deep dive is essentially a real-time autopsy of how a legacy software behemoth attempts to survive a total technological disruption.
That's exactly what this is. I mean, Intuit is overwhelmingly a service business now. By the third quarter of fiscal 2026, service revenue made up 91% of the total revenue.
91%.
Yeah. They are not selling you software. They are renting you access to outcomes.
Renting access. And they're doing it across a very strange mix of models, too. The report highlights 4 distinct monetization strategies operating basically simultaneously.
Right. It's a complex machine.
First, you have recurring subscription revenue, which is primarily QuickBooks Online. You pay a monthly fee, you get the software. Simple enough, right?
Very simple. But then you have per transaction revenue. That is TurboTax.
Ah, okay.
Because you don't pay a monthly subscription for TurboTax all year round.
Yeah.
You only pay a fee at the exact moment you hit file to send your return to the IRS.
Right. And then the third model is volume-based revenue. This is driven mostly by their payment processing business, which the analysis notes was up 30% in Q3.
That's a huge growth segment for them. When a small business sends an invoice through QuickBooks and the customer pays it via credit card or bank transfer, Intuit takes a slice of that actual transaction volume.
And then the fourth model is performance-based revenue, which is basically Credit Karma, right?
Yeah, that's almost entirely Credit Karma.
They give you a free app to check your credit score, and they only get paid by a bank if you actually click through and get approved for a credit card or a loan they recommend.
Which is essentially an advertising business disguised as a financial tool.
Wow.
I mean, they act as a massive lead generation funnel for large financial institutions.
I saw the geographic breakdown, and 92% of their revenue is domestic.
Yep. The report notes their international expansion has been stalled at 8% for 3 consecutive years. But Intuit has completely failed to capture that global market share. Competitors like Xero have built incredibly dominant positions in the UK, Australia, New Zealand.
So Intuit is effectively trapped in his domestic fortress.
TurboTax is entirely dependent on a narrow window of legally mandated behavior. The IRS says you must file by April 15th, so everyone stampedes into the pop-up shop at the exact same time. Credit Karma, as we established, is an advertising business. When a recession hits, credit tightens. Banks immediately pull back on lending because they're afraid consumers will default.
Right. They stop approving people.
Exactly. If banks stop issuing new credit cards, Credit Karma has nothing to sell, and their revenue plummets. In fact, Credit Karma's revenue fell 9% in fiscal 2023 during the last credit tightening cycle.
Wow. And I'm guessing the same logic applies to the volume-based payment processing for QuickBooks.
Spot on.
If a small business using their software sees a massive drop in sales because consumers stop spending money, Intuit's percentage cut of those sales drops in lockstep.
Precisely. They have tied their own fate to the macroeconomic success of their users.
Which is dangerous in a downturn.
Very. And there's a third massive cyclical exposure we need to cover later, which involves Intuit actually taking credit risk on its own balance sheet.
Oh, right. The lending side.
Yeah. But the core takeaway here is that while the underlying action of bookkeeping is recession-proof, Intuit's ability to extract premium margins from it is highly fragile.
That perfectly bridges us into the actual defensive walls around this company, because to understand the stock collapse, we have to look at their economic moat. And the sources here are absolutely brutal.
They do not hold back.
The report explicitly states Intuit's moat size is narrow and its direction is narrowing. Morningstar officially downgraded Intuit from wide to narrow in March 2026.
And we should emphasize a downgrade from wide to narrow from a major research firm like Morningstar is a massive institutional signal.
It's a huge deal.
It changes how every portfolio manager values the stock.
Let's start with network effects. Do they have one?
The report is very clear on this. They have absolutely zero network effects. If your neighbor starts using TurboTax, it provides absolutely zero additional value to your TurboTax experience. Your tax return doesn't get faster or more accurate because someone else is using the software.
Makes total sense. So what about a low-cost production moat? do they have a structural advantage that allows them to produce software cheaper than anyone else?
Not at all. Intuit spent $4.27 billion on selling and marketing in just the first 9 months of fiscal 2026.
So that leaves switching costs as their one and only line of defense. The friction required for a customer to leave and go to a competitor. And the report notes that this defense is completely split down the middle. For QuickBooks, it seems incredibly strong.
It is exceptionally strong for QuickBooks. If you run a business, your general ledger, your historical payroll data, your bank feeds, and most importantly, your accountant's entire workflow are all wired directly into that software.
Right. It's the nerve center.
The friction to rip that out is massive. You'd have to pause operations, risk corrupting your financial data during the conversion process, and retrain your entire administrative staff on a new system.
It sounds like an absolute nightmare.
It is. And because of that pain, businesses just swallow whatever price increase Intuit hands them every single year.
They're trapped. But then you look at TurboTax, and the switching cost is remarkably weak. I mean, if I'm a regular consumer filing a simple W-2, my only real friction is interface familiarity.
Right.
I just like the way the buttons look, and it's convenient that they already have my name and last year's standard deduction saved. There's no deep organizational lock-in for me. I can literally just go to H&R Block's website and type in my W-2 data in 10 minutes.
And this is where the SaaS-pocalypse thesis takes center stage.
And AI can ingest a PDF of my tax documents and prepare a simple return instantly through a blank chat window. I no longer care about how user-friendly TurboTax's menus are because the AI bypassed the need for menus entirely.
That is exactly what Morningstar saw when they downgraded the mode.
Sources provide glaring, undeniable evidence from Intuit's own fiscal 2026 guidance that this collapse is happening right now.
It's in the numbers.
Intuit proudly guided that their TurboTax average revenue per user, or ARPU, is going up 11%, which, to an uneducated observer, sounds like a massive win.
Sure, double-digit growth sounds great.
But then you look at the volume metrics. Their total TurboTax online units are guided down 2%. Their total share of electronic files in the United States is down a full point.
And it gets worse at the bottom.
Right. Their pay-nothing customers, the absolute entry tier of their funnel, are dropping from 8 million down to 7 million users. They lost 1 million free users.
When your average revenue per user goes up by double digits, but your total unit volume is actually shrinking, you are experiencing a phenomenon called mix shift.
Mix shift, okay. They're focusing on increasing the monetization depth per customer, meaning if they have you, they're going to figure out every possible way to extract another dollar from you.
Exactly. And the analysis shows a few specific areas where this pivot is highly successful.
Okay, let's hear them.
The first is their move upmarket into the mid-market segment. They recently launched the Intuit Enterprise Suite, targeting larger, more complex businesses. Contracts for that suite were up 37% quarter over quarter.
Wow, 37%.
And their overall mid-market growth is up north of 30%.
So they are abandoning the guy with a lawnmower business who might use a free AI tool and focusing on a manufacturing company with 50 employees that desperately needs complex payroll and inventory management.
It is a smart defensive move. They are retreating upmarket, where the competition is weaker, the switching costs are much higher, and the revenue per customer is massive.
Makes sense.
But they are also weaponizing their existing assets to force-feed the consumer funnel. Which brings us back to Credit Karma.
Oh, this is one of the wildest data points in the entire analysis. Intuit bought Credit Karma a few years ago. It's basically a free app that tells you your credit score and recommends credit cards. But Intuit is now using it as a massive zero-cost acquisition funnel, specifically to catch people and drag them into TurboTax.
We call this funnel physics.
Yeah.
Because Intuit is losing standalone DIY tax filers who are just, searching Google for free tax prep. They have to catch them somewhere else. Right. Credit Karma still holds immense standalone appeal because people are obsessed with monitoring their credit scores. So, Intuit catches the consumer at the top of the funnel in the free Credit Karma app at zero incremental acquisition cost.
Ingenious.
Then, right when tax season hits, the app aggressively prompts the user to file their taxes directly inside the Credit Karma interface using TurboTax on the back end.
The report states that tax filers who start their journey inside the Credit Karma app are expected to grow by 54%.
It's a massive growth vector.
It is brilliant, but it's also, well, it feels like a defensive necessity. They are trying to build a walled garden. They want to handle your bank, your marketing, your payroll, and your credit score all integrated together.
Yep. Once you are using 3 or 4 of their products, the perceived friction to leave the ecosystem entirely becomes overwhelming.
The analysis classifies Intuit as being in Phase 5 capital return. What does that mean for a company's life cycle?
Phase 5 means a company has fully matured. It has moved past its hypergrowth phase, where it reinvests every dollar into conquering new markets.
Okay.
Its primary function is now to act as an extraction engine. It generates massive amounts of free cash flow and returns that cash to its shareholders through dividends and stock buybacks.
And their extraction engine is running incredibly hot. In fiscal 2025, they generated $6.08 billion in free cash flow on $3.86 billion in net income. That is a free cash flow to net income conversion rate of 157%.
It's a huge number.
They have a pristine net cash position with $6.95 billion in cash versus $6.16 billion in debt. They've raised their dividend for 15 consecutive years, and they just authorized a massive new $8 billion share buyback program. I mean, on paper, it looks like an absolute fortress. Before we go hunting for cracks in the foundation, we really need to understand how wide this company's foundation actually is.
Right. Because to appreciate the threat, you really have to appreciate the scale first. Historically, Intuit's defensive walls have been incredibly formidable.
Let's talk about their safety net. The document highlights their incredibly low concentration risk. Like we mentioned, they have around 100 million customers spread across 4 different buyer groups.
Yeah.
And the statistic that really blew my mind from the filings, not a single customer accounts for more than 10% of their revenue.
So from a structural business standpoint,
Yeah.
I mean, that is the holy grail.
Right.
While that base is incredibly wide, the analysis deck highlights that Intuit's disruption risk is currently rated as HIGH. High, and the trend line is pointing upward. Morningstar, which is, one of the most prominent independent investment research firms, officially downgraded Intuit's economic moat.
Wow.
Yeah, they moved it from wide to narrow.
Meaning they don't think Intuit's castle walls are as impenetrable as they used to be?
Exactly. They essentially declare that the rapid expansion of AI capabilities is starting to bridge that defensive moat.
Just like that.
They did. And this brings up their competition risk, which the analysis rates as medium but rising. During the 2026 tax season, the low-end do-it-yourself tax market saw incredibly fierce, highly aggressive price competition.
Let's look at the recent balance sheet, Part 6 of the deck, specifically the data from April 30, 2026.
Well, if you were just skimming the top-line financials, you would probably walk away thinking everything is perfectly fine. Out of the 5 standard red flag categories the analyst evaluated, 4 of them are completely solid.
Okay, let's lay out those clean metrics so we have the full context before we get to the actual problem.
They are operating from a massive position of strength in terms of liquidity. Yes, they carry about $6.16 billion in debt, but their cash and short-term investments total $6.95 billion.
Okay.
So they're essentially sitting on nearly $800 million in pure net cash.
A very comfortable rainy day fund.
Absolutely. On top of that, their retained earnings are massively positive. We're talking $22.8 billion in retained earnings.
Wow.
And that number is actually rising even after they returned a massive amount of capital to shareholders. They spent over $3.3 billion on stock buybacks and paid out over $1 billion in dividends in just a 9-month period.
So they are throwing off a ton of cash. Let's talk about goodwill, though. That's usually where things get messy for tech giants that gobble up other companies, right? Like when Intuit bought Mailchimp and Credit Karma.
Yeah, goodwill is a critical metric to watch. For anyone unfamiliar, it's essentially the premium a company pays over the actual tangible book value when they acquire another business.
Like paying for brand reputation, user base, things you can't easily put a hard price tag on.
Exactly. For Intuit, goodwill sits at about $13.9 billion. That represents 35.5% of their total assets.
Over a third of their assets is just the premium they paid for other brands. That feels a bit high, doesn't it?
It is a significant chunk of their balance sheet, for sure. But it remains safely under the 50% threshold, where financial analysts really start sounding alarms about overvaluation.
Okay, so the cash is there, the earnings are strong, the debt is manageable. But I want to zero in on the one glaring yellow severity flag the analysts found. accounts receivable.
Yeah, this is where things get slightly complicated.
The deck points out that Intuit's accounts receivable grew by 15.2% year over year, but their actual revenue for that same 9-month period only grew by 14%.
Right.
So are they getting desperate? Are they just handing out extended payment terms to keep the growth narrative alive for Wall Street?
The analyst actually provides a very reassuring context for this specific flag. It is a relatively small excess, and it makes total logical sense when you consider how Intuit is restructuring its business to compensate for losing those DIY consumers.
You mean the million free users who walked out the door?
Right. To counter that loss, Intuit is aggressively moving upmarket. They are expanding their mid-market business with things like the Intuit Enterprise Suite, which saw a 37% quarter-over-quarter growth.
And a mid-market enterprise customer doesn't just put their company's accounting software on a corporate credit card on a website.
Exactly. B2B sales operate entirely differently than consumer software. When you sell to a massive corporation, they don't pay up front. They put you on a 30-day or 60-day invoice cycle.
That makes total sense.
So as Intuit shifts its focus toward larger corporate clients, naturally, their stack of invoices, their accounts receivable, is going to grow a bit faster than the immediate cash coming in. It's a structural shift in who they're selling to.
The analysis breaks down the valuation in Part 7, noting that Intuit trades at roughly 20 times its fiscal 2026 GAAP earnings. But if you look at their non-GAAP earnings, they only trade at 13 times.
That is a massive discrepancy. A multiple of 20 implies a fairly valued, perhaps slightly expensive legacy company. A multiple of 13 implies a deeply undervalued, screaming bargain.
Right. It's night and day.
The difference between those two numbers entirely dictates whether you buy or sell the stock.
I need you to explain this discrepancy because the report explicitly states that the gap is heavily driven by $2.1 billion in share-based compensation. What exactly is the difference between GAAP and non-GAAP, and how does paying employees in stock create this massive gap?
Okay, so GAAP stands for Generally Accepted Accounting Principles. It is the strict, legally mandated set of accounting rules every company must follow to ensure consistency.
Got it.
Under GAAP, if you pay an engineer $100,000 in cash or $100,000 in company stock, it is recorded as an identical $100,000 expense that lowers your official profit.
That makes perfect sense. An expense is an expense, regardless of how you pay it.
But Wall Street loves non-GAAP earnings, which are basically customized, adjusted numbers, where management gets to legally ignore certain expenses to make the company look more profitable.
Sneaky.
Intuit, like many tech companies, argues that because handing out stock doesn't require them to actually spend physical cash from their bank account, they shouldn't have to count it as a real expense when presenting their non-GAAP profit to investors.
We've talked extensively about the business mechanics. Now we have to look at the financial fallout.
And it was severe.
The stock drastically, catastrophically underperformed the market, falling roughly 60% over 12 months, while the broader S&P 500 was up 20%.
The primary catalyst for the climax of that crash was the May 20th, 2026 earnings report.
Let's walk through exactly what happened on that day because the optics were disastrous. Intuit comes out and announces a 17% global workforce cut, 17% of their entire employee base gone.
Massive.
And it comes with a $300 million restructuring charge. While announcing this massive layoff, they simultaneously cut their full-year TurboTax revenue guidance. The market took one look at that combination, realized the growth engine had seized up, and the stock tanked 20% in a single trading session.
From a signaling perspective, a 17% cut is a blaring alarm. You do not cut almost a fifth of your global workforce, effectively admitting your entire cost structure is completely misaligned with your market reality if you believe the transition to an AI-driven future is going to be smooth and profitable.
Right, you just don't.
It was a panic pivot to protect cash flow, and institutional investors recognized it instantly. It creates a fascinating bull versus bear debate in the market right now.
Let's hear both sides.
If we look at the bull case, the optimists argue that Intuit is a completely misunderstood cash cow. They argue the stock is trading at a massive discount to its historical averages. They have a pristine balance sheet overflowing with cash. They're aggressively buying back their own stock, $3.3 billion worth in just 9 months. And their upmarket business serving complex enterprises is growing at 30%.
Okay, that sounds compelling.
The bulls believe the market is hysterically overreacting to the loss of free, unprofitable DIY tax filers.
I understand that argument. If the people leaving weren't paying you anyway, who cares? Just focus on the rich clients. But the bears, backed by the exiting institutional money and the insider selling, look at the underlying reality of the funnel.
The bulls think Intuit can outrun the AI threat by migrating their existing massive user base to higher-margin, human-assisted products like TurboTax Live.
And the bears?
The bears believe the bottom of the funnel will collapse so fast and the AI will become so reliable that the top of the funnel will eventually starve to death.
Let's get into the mechanics of this disruption. The analysis assesses Intuit's resistance to AI in Part 9, and it gives them an overall rating of robust, but with a major blinking red caveat. It splits their business into what is anti-fragile, meaning it actually gets stronger or defends itself well against AI, and what is fragile.
Right. Let's start with the anti-fragile side. The report highlights liability and hallucination risk. If an AI hallucinates on your corporate general ledger or incorrectly calculates depreciation on your federal tax return, it is an unmitigated disaster.
The cost of being wrong is just too severe. You are looking at IRS penalties, expensive formal audits, or misstated financials that can lead to massive shareholder lawsuits.
Because of that inherent asymmetric risk, customers operating at the high end of the market are terrified of raw AI. They're actually willing to pay a massive premium for human sign-off.
Right. And Intuit capitalized on this by creating TurboTax Live. This product is essentially their automated tax prep engine paired with a certified human expert who reviews and verifies the work, thereby taking on the liability.
And it is working incredibly well. The guidance shows TurboTax Live is expected to grow 36% to $2.8 billion.
That is massive growth.
It is. That single hybrid product now accounts for 53% of total TurboTax revenue.
They also have a second anti-fragile characteristic, which the report calls network and data gravity.
Intuit holds proprietary, non-scrapable data on 100 million customers.
Non-scrapable meaning an outside AI can't see it.
Exactly. They have decades of general ledgers, historical tax returns, granular payroll histories, and credit files. An AI model trained by a competitor out on the open, public internet cannot access Intuit's walled garden.
So it's safe.
That proprietary data is a massive defensive asset because it allows Intuit to train localized AI models that are far more accurate for their specific users than a generic public model ever could be. The critical failure point is the highly price-sensitive do-it-yourself filer with a simple W-2.
The entry level, the absolute bottom of the funnel.
Yes. Think about a 22-year-old, fresh out of college, renting an apartment with one single W-2 form from their employer and taking the standard deduction.
Very simple situation.
For that specific user, the tax filing task is incredibly bounded. It requires zero creative interpretation of tax law. It's just basic arithmetic and form filling.
And because it is so rigid and deterministic, a modern AI model simply will not hallucinate on a standard W-2.
Precisely. And furthermore, for that 22-year-old, the cost of an error is phenomenally low.
Right, they don't have complex assets.
The IRS is not going to launch a full-scale, devastating audit over a $50 discrepancy on $40,000 income. If there is a slight error, the IRS usually just corrects it automatically and sends a notice.
So for this massive cohort of people, the AI is completely reliable, it costs literally nothing, and the fear factor of being audited is non-existent. There is absolutely no reason for them to ever pay for TurboTax.
And this is exactly where Intuit is actively bleeding users. Historically, Intuit's entire model was based on grabbing that 22-year-old for free. They lose money on them for the first 5 years. But then, that 22-year-old turns 30. They buy a house, so they have mortgage interest to deduct. They have a child, introducing dependents and child tax credits. They start a freelance side hustle, introducing 1099 income and Schedule C expenses.
Their financial life gets incredibly complex.
Exactly. And because they are already deeply familiar with the TurboTax interface, they simply upgrade to the paid tier and eventually to TurboTax Live. Intuit monetizes the complexity of their aging demographic.
Oh, I see.
But if you lose that person at age 22 to a free open-source AI bot, they are never entering your ecosystem. When their life gets complex at 32, they're just going to ask that same AI bot to handle the new complexity. And part 10 of the analysis, which tracks the smart money, is absolutely brutal for the bull case.
It really is. Two highly respected super investors, Terry Smith of Fundsmith and Gavin Baker of Atreides Management, exited their positions entirely in Q1 of 2026.
They completely liquidated their massive holdings before the horrific May crash.
That timing is incredible.
The Fundsmith exit is particularly notable because Terry Smith is known for buying high-quality, wide-moat companies and holding them for decades.
Right.
Furthermore, Fundsmith had only recently rebuilt their position in Intuit after previous volatility. To rebuild a massive position, do all that deep research, and then immediately decide to exit entirely signifies a fundamental break in their investment thesis.
And the report explicitly notes there were zero, absolutely zero open market purchases from any insiders. Not a single person in the C-suite, not the CEO, not the CFO, not a single member of the board of directors reached into their own personal bank account to buy the stock, even after it crashed 60% and was supposedly trading at this bargain non-GAAP valuation. So we have to bring this all together. What is the ultimate takeaway for someone looking at this massive 11-part analysis? The master narrative here is a story of profound contradictions. Intuit is a highly profitable, cash-generating machine with a bulletproof balance sheet. But its wide moat, the very familiarity and switching costs that protected it for decades, has been permanently narrowed by natural language AI.
It is actively losing the entry-level consumer to cheaper, faster alternatives.
Think about that proprietary data moat we discussed. 100 million customers' entire financial histories locked behind a wall. Could Intuit's ultimate destiny, maybe a decade from now, simply be acting as a massive, silent data oracle?
A data oracle.
Right. Instead of selling you a tax product, could their future simply be renting out the historical financial behavior, the deep, non-scrapable economic data of 100 million Americans, to banks, institutions, and other AI companies to train their own models?
It's a fascinating potential evolution, moving from selling the tools that collect the data to simply selling the data itself.
Exactly. It's like building a massive highway network, realizing you can't charge tolls anymore because everyone just bought flying cars, but realizing you are the only one who owns the data on exactly where everyone actually wants to go.
That's a perfect way to look at it.
Thank you for joining us on this deep dive. Keep questioning the numbers behind narratives, look out for those non-GAAP adjustments, and we'll see you next time.